This is Business Edge on News Central. I'm Mtwalo Msoni. Our headline story. Forecast of South Africa's Q1 2021 monetary policy meeting. Recession and the coronavirus-induced lockdown have dealt severely with South Africa. Her institutions are struggling to stay in business as COVID-19 continues to claim more lives. And now President Cyril Ramaphosa, his cabinet and parliament all agree that it's time to work together. We'll be focusing on their plan of action to get South Africa working again. We'll also touch base with a few stories we're keeping our eyes on with NC4 to watch before we finish the show. Welcome. This is Business Edge. Now, South Africa's Reserve Bank is expected to keep its repo rate at a record low of 3.50% at its January 21st meeting and for the rest of 2021 as the coronavirus pandemic rages and with inflation expected to remain benign, according to a Reuters poll. Repo rate or repurchase rate is the key monetary policy rate of interest at which the central bank, or rather in this case, the Reserve Bank of South Africa, lends short-term money to banks, essentially to control credit availability, inflation, and economic growth. Now, the repo rate is the most significant rate for the average citizen. Everything from interest rates on loans to returns on deposits is influenced by this crucial rate set by the RBSA. This is why interest rates on home loans, car loans, and other kinds of borrowing go up and down based on the direction of the repo rate change. Similarly, banks adjust savings accounts and fixed deposit returns based on this benchmark. According to the Reuters poll, 17 out of 20 economists anticipate that the Reserve Bank governor will hold rates steady this month, after cutting them a cumulative 300 basis points last year as the pandemic swept the world. The remaining three analysts forecast a 25 basis points cut. Inflation, which turned much weaker last year compared to previous years, is expected to average 3.8% this year, lower than the midpoint of the Reserve Bank's comfort range. South Africa's already overblown budget has been hamstrung by the coronavirus, setting the stage for difficult public sector wage and tax deliberations in the upcoming February budget. The country's economy is expected to grow by 3.5% this year, the poll conducted this week has shown. This after a 7.4% contraction last year predicated on the December poll. Now, joining me on Business Edge is Global Tax Advisor Mtwalo Msoni. He is an economist and researcher currently in Lusaka, Zambia. Mtwalo, good afternoon to you where you are, and welcome to Business Edge.
Thank you very much. Good morning to you. Pleasure is all mine to be part of the show.
All right, so let's get into this conversation. Africa's most industrialized economy, the second largest economy on the continent, also in recession, unfortunately, like Nigeria as well. So it's very vital to the continent that these two recessions get their acts right. But looking at the rates, particularly for South Africa, if the rates are held steady, do you think that this will in turn boost lending and probably spur the economy?
Consumer behavior dictates that it does boost lending in the sense that the lending rates are sort of lower. And because lending rates are sort of low, it basically means that South Africa can now afford to make loans to consumers of loans at a lower rate. I think this percentage point cut comes at a record low for over a 40-year period, and it's all in efforts of South Africa to contain the coronavirus by ensuring there is liquidity and enough economic activity. And because the rates are this low, we do know that now banks in South Africa are offering loans to a wider range of people at lower rates of between 7 and 10% interest payments. And because these rates have been maintained, we do know that the cost of borrowing money in South Africa will trickle down to the ordinary citizens at a lower rate. Usually, repurchase rates are used as an economic monetary policy, which is used to control inflation and liquidity in the economy. And as we can see now, South Africa has managed to control and is seeing controlled rates of inflation, which are just slightly above 3.5%. It basically means that the effects of having lower lending rates, the negative effects of having lower lending rates have not yet hit South Africa. And they can continue to maintain a 3.5 repurchase rate between the central bank, the Central Reserve Bank, and commercial banks.
Okay, so as we continue the conversation on rates, we know that rates were cut by around 300 basis points throughout cumulatively for 2020. Now we're looking at another month of holding rates. How long do you think this rate can be cut, rather kept at this level we're seeing? If we're going to hold out at this level, we're just entering 2021. Many are saying that the rates will stay this way to the end of the year. But what do you think? How long can South Africa maintain this rate before there has to be some form of adjustment?
So the Monetary Policy Committee in South Africa made mention earlier this year that they're going to base whatever decision they have on cutting basis points based on evidence, based on data. And in this case, it's the inflation data that they're looking at. Some economists have predicted that there'll be lower rates of inflation throughout the year because of the decline in economic activity, because of some of the effects of this lockdown and shutdown of some of the businesses. So based on this, I would predict that in the midterm, for the rest of the year, we would look at maintaining the 3.5 basis points. So I would add to the 17 out of 20 economists who have predicted that this rate will be maintained, and also predict that for the midterm, looking at the projection of inflation and the outcomes of inflation throughout the year 2020 during the pandemic, such a rate would be maintained and only adjusted as and when we have different projections and different outcomes from the inflation perspective.
All right. Now, considering the fact that South Africa is back on lockdown, a level 3-1 at that, are there any positives here? Are loans being given out to aid economic recovery? Is there anything positive that we've seen happening in this period right before we get into the president's economic reconstruction and recovery plan?
The president's economic and reconstruction recovery plan, and I'm glad we're going to go to that, is based on the fact that liquidity is quite important for the economy to survive, for it to recover. And this is why we have seen South Africa being amongst the top countries that has decided to dedicate a huge portion of their GDP to economic recovery, to supporting the health sector, to supporting some of the sectors that have collapsed because of lockdown restrictions and so on and so forth. So in terms of liquidity, this is more of the same. I think it will be central banks' priority to ensure that the commercial banks are giving out loans, lending out money at a lower rate, because this in turn stimulates economic activity and would support businesses, keeping people in employment and help containing the effects of the pandemic. And I think this will be what will be emphasized next Thursday as the Monetary Policy Committee statement comes out. I think there'll be an emphasis to say we are maintaining a 3.5 rate, or maybe cutting by 25, which is unlikely in this case, because we want commercial banks to continue lending out money at a lower rate. So we're likely to see more and more people borrowing this money at a lower rate. And for those who have existing loans with variable interest rates, at least they'll have some form of debt relief, because now they can afford to pay back their loans at a lower rate than they would have borrowed earlier. For the ones who are traditionally into saving money, I think the incentive of saving money during this period is very minimal. The opportunity cost of holding on to money is the interest rate, and in this case, interest is very low. So we're likely to see that even those that are traditionally saving money will try to spend more during this period because of the low interest rates that are being offered by the commercial banks as a trickle-down effect of the repurchase rate.
Okay, that makes sense. So let's get to President Cyril Ramaphosa's economic reconstruction and recovery plan. And the plan was to restore the South African economy following the devastation caused by the pandemic. It amounted to approximately $26 billion, or about 10% of South Africa's GDP. As a share of GDP, South Africa's package represented the largest in the emerging markets, notably larger than several high-income countries, including South Korea and Canada. Even when only examining above-the-line expenditures by government, South Africa was willing to spend enormous amounts of money to get the country back on its feet. So did the ERRP achieve even partially any of its aims, or the majority of its aims, or the idea behind why it was created before this second wave hits? Because now with the second wave, it feels like the presidency may need to sort of reintroduce another plan or pick up from where they stopped with this one.
So you made mention of did it partially achieve? Partially achieve, yes. I think there was much needed resource to aid response to health, the health sector, much needed aid to help small and emerging businesses that had run out of business, of course, because of the pandemic and the effects of the lockdown. But to a larger extent, if you look at the amount of money involved, we're talking about 10% of GDP for a country that is still classified in terms of the emerging market spending as much as the higher income countries. You would have expected to see a larger outturn in terms of what would happen for economic growth. South Africa's economy declined by over negative 7%. So this is a direct indication that there's much more that needed to be desired, and the extent to which this economic recovery plan wanted to achieve its desired objectives is not achieved in full. Quite all right, there were some resources that were set aside to support emerging business, support the health sector, but this wasn't enough, and we would have seen more. Of course, we have heard statements of questionable management of these resources, where they would have been better managed and would have been seeing better economic outcomes throughout the year. But to a large extent, I think with the second wave, which is very unpredictable, we might need some form of re-strategizing of this economic recovery plan for it to achieve intended objectives and it to work on one of the most important priorities right now, which is employment creation, which is pushing more and more South Africans into poverty.
Okay, so let's continue this conversation right now. South Africa's growth prediction is hinged on activities of all sectors of the economy. But as we know anywhere, some will add more and will perform better than others. What sectors are we looking at to fuel South Africa's recovery?
So some of the sectors that are looking at fueling South Africa's recovery, of course, based on the annualized rates of GDP that came out, is the manufacturing sector. I think the manufacturing sector looks to be on course of recovery. And as you know, manufacturing is closely linked to the trade sector. But unfortunately, some of the variables in the trade sector, such as lockdowns in other countries, decline in demand for commodities that are traditionally boosted in South Africa, are out of the hands of the South African economy to manage. Some of these variables cannot be managed locally. So in as much as manufacturing sector seems to have been a route into recovery for South Africa, some of the variables that affect the manufacturing capacity of the country and the appetite of the country to manufacture are out of the hands of the South Africa. The external variables that are dependent on different economies. So unfortunately, we have a gateway, but the gateway is very uncertain now that there's a second wave, and different countries are responding to the second wave in different ways. Yes. So we're not pretty sure at this point that manufacturing will continue to spare South Africa out of this, because it closely links to trade. And because of the phase 3 lockdown, we do know that borders in South Africa will close. Yeah. This inhibits trade, disrupts supply chains, and would probably see a decline in the manufacturing sector, which was the increase. Same applies for agriculture. Agriculture has actually been on the decline. This is one of the traditional sectors that you would want to see growing in South Africa, is to be on the road to recovery. And unfortunately, agriculture sector has been declining. Mining has maintained some form of stability, but we'll see how the new wave of the virus, the new variant of the virus, will be able to affect some of these macroeconomic outturns of the country.
Okay, so do you foresee the possibility of bigger or better investments in South Africa this year? Many countries have taken hits, particularly on the continent, in terms of FDI and investments into the country. What do you foresee in terms of South Africa and investments coming in?
One of the likely and hoped for effects of having a lower rate of lending money is that investments will increase. But unfortunately, investments are also driven by the factors of demand. Yes. It's the demand that will affect the supply decisions that a company has to make. It's very difficult to tell at this point if investment will increase. I think it's very dependent on how soon the country can get back to its feet, how soon it can implement its plan for a vaccination program, at least to get people back in business, and this will create a platform and favorable environment for investments, especially if the repo rate is maintained at current 3.5. I think there's a very good incentive for borrowing money to invest, because at least you'd be assured that you won't have to spend all the money that you'd make out of your investment on paying back on the loan that you acquired.
Okay, so let's talk about some more analysts in the sector. Goldman Sachs analyst wrote that the combination of significant spare capacity and rand strength would unfortunately continue to weigh on inflation through 2021, leading to a persistent undershoot of the midpoint inflation target range and an additional 75 basis points of easing. I've said all of that, and for many people, it might just sound like financial jargon. So, Mtwalo, please break this down for the average South African.
This basically probably means that there's a projection that inflation, the increase in the price of goods and services compared to the previous year for 2021 will be lower. That would probably be a projection that inflation will be 2.75% going into 2021 and probably part of 2022. This basically means goods and services will increase by about 2.7%. Okay. Looking at the basis point cut in terms of the repo rate and, of course, what would be the interest rate on the loans, I think this is quite unlikely. And for me, I would probably predict that we would see the inflation being within the range that has been predicted by the government, between 3 and 4%, probably leaning closely to 3.8 and 4%, because, of course, we've got an increase in money supply. Money is easier to attend now. So because of an increase in money supply, more money in the economy, more liquidity in the economy would mean higher inflation after. So I think we will still be between the 3 and 6%, probably leaning closer to the 4%. And this is based on some of the figures that has come out of the Reserve Bank and some of the economic outturns and performance of inflation throughout 2020.
All right, so we're going to start wrapping up, but let's also take this. Economists at the same investment bank, that's Goldman Sachs, were one of the first to expect disinflationary trends in South Africa, and they also expect rates to be cut by, or rather cut to 2.75% this year and stay there through about 2023 due to continual weak inflation. What do you think about this?
This will be very dependent on monetary policy again. It will be dependent on the rates at which the Reserve Bank will provide finances to central bank. If the Reserve Bank provides a platform where central banks can purchase securities at a lower rate, it basically means that inflation outcomes will be maintained to be between 3 to 6% over the long term. Disinflation outcomes, of course, have been mainly influenced by the fact that there's very little economic activity, very little money in circulation in the economy, and this is what the government has been trying to address by having monetary policy measures such as having a 40-time low in terms of the repo rate, make money more available to people by making the cost of borrowing money cheaper. You incentivize people to borrow more money. And if they borrow more money, unfortunately, and you have a flood of money, you have an increase in inflation. Because of these disinflationary trends, we're already seeing that the central bank has got the incentive to at least make the cost of borrowing money cheaper. And this is why we even have a 3.5 repo rate for central banks. So
very quickly, yes or no with a simple one-sentence answer. We can't talk about South Africa's economy for 2021 without talking about the potential that the COVID vaccine has for helping to get the recovery going. So we know that the president signed on to the UN-led COVAX initiative. We also know that others across the continent in many ways are sourcing for vaccines. Do you think if vaccines were to come into play, let's say next week or even by the end of February, would this sort of increase the possibility of us looking at more positive, brighter numbers and figures as it pertains to South Africa's economy?
Yes, because trade will get back to its feet. South Africa will open its borders and alcohol consumption will resume in South Africa, which is also a big part of the economy.
Yes, as well as tourism. All right, we'll end on this note for now. Thank you so much, Mtwalo Msoni, for joining me on Business Edge, joining us from Lusaka in Zambia. We look forward to speaking to you again.
All right, thank you.
All right. And as you know what we do, we wrap things up with NC4 to watch. A few stories we're keeping our eyes on. Nigeria's benchmark monetary policy rate has been predicted to rise by 200 basis points to 13.5% in 2021, up from the 11.5% it is presently. Bloomberg Economics made the prediction in the media outfit's quarterly guide, which is entitled Ultra Low Interest Rates Are Here to Stay 2021 Central Bank Guide. It pointed out that the Central Bank of Nigeria is looking at changes. Egypt is seeking a $1 billion loan from the International Islamic Trade Finance Corporation to finance petroleum reports. This is according to the country's Minister of Petroleum. The loan will cover 2021 petroleum imports. It is also part of a $3 billion agreement that was signed between Egypt's Ministry of Investment and the ITFC in January 2018. Huawei Technologies has expressed interest to venture into Ethiopia as the country starts to open up its telecommunications sector. The company plans to cement its position as a vendor of the state-owned monopoly Ethio Telecom, aiming to bid for opportunities in Ethiopia. And finally, Namibia has been hit by another outbreak of highly contagious foot and mouth disease after the detection of infected cattle in the northern regions of Oshana and Ohangwena, the Ministry of Agriculture has said. And that's it on this edition of Business Edge. Follow us on social media. We are at New Central TV. Head to our website and also download our mobile app on Play Store and iOS to catch up with all our news and programs. Until next time, which means Monday, I'll see you later. I'm Tolu Lokpe Adileru Balogun.